Okay, so back to kind of your wheelhouse, and I know you can't speak on behalf of any other super funds, and I'm okay if you speak to your portfolios. Global markets and super funds.
Yep.
Most of us who have a super fund have an allocation to international equities, US, Europe, and whatnot. Are there certain sectors within that are hit harder by trade tensions? And how does basically what's going on at the moment particularly impact that portion of global exposure in the super fund? And I think I'm just going to throw a heap of stuff out and you can take it wherever you want.
Okay.
Because we need to understand that within a super fund portfolio, it is a balanced portfolio. We're going to have Australian shares, US shares.
Yes.
We're going to have unlisted
European,
property.
Japanese shares.
We're going to have alternative
Correct.
assets. There might be a bit of gold. There might be
A whole range
variety of
different
things. So how, I don't know, if you want to just take it anywhere from there, like global markets, super funds, and I know you can speak on behalf of Australian Retirement Trust, but what's the impact?
Okay. Firstly, trade wars are bad for growth, and if they're bad for growth, it means it's bad for company profits, which in turn is bad for share prices, if I can put it simply. And so consequently, which is why share markets have responded so badly to the imposition of tariffs, because it's fundamentally bad for growth and bad for business. That said, there are clearly some markets that are going to be more severely affected than others. So to the extent that, and this does vary on a daily basis, but if you're an economy that is very, very heavily dependent on international trade, then you're probably going to suffer more, and maybe your share prices will get more hurt as a result. At the company level, companies that are mainly focused on servicing their domestic market should actually hold up maybe a bit better. To the extent that your costs or your sales are going to be more damaged because of the tariffs, clearly your performance is going to be more severely affected. Initially, share markets, when they get a shock like this, there's this initial panic, if you like, and then maybe after a while markets become a bit more discerning and identify which companies and which sectors are going to be more hard hit than others. But as a general statement, share markets have responded the way they have, because tariffs are bad for growth and bad for profits. Now, the other story here is a diversification.
And just on that, the sudden swings that we've been seeing, I think last week, or there was a rumor that tariffs were going to be off. Market shot up in one day. Oh no, not a rumor. Went back down.
Yes.
2 days later.
The trading the other day was so
volatile.
volatile. The trading the other day was so volatile because any hint the tariffs might come off, you saw the response, and then it was like, no, they're not coming off, and the market tanked again. The other story here is diversification. So while share markets have been hurt by the damage the tariffs could potentially do to economic growth and to profits, bonds have actually held up reasonably well because, generally speaking, if the economy is going to be weaker, it means the central banks may actually cut interest rates a bit further, and that's generally supported bonds. So bonds have done very well. But the other story here is the private assets. So Australian superannuation funds in general, and ART in particular, we tend to run about 30% of our portfolio in what we call unlisted or private assets.
So they're not going to get the volatility.
Not the same volatility, no. And again, a lot of these assets.
Can you give an example of one of those assets?
Yeah,
in the
so
portfolio?
things like, for example, in real estate, it could be things like aged care facilities here in Australia and the UK. It could be commercial office buildings, which are clearly going to be impacted by a downturn in the economy if that were to happen. But things like holiday parks. So we invest in the G'day Group, which is Australia's probably largest holiday park operator. We invest in things like industrial properties, so just big tin sheds that store stuff and distribute stuff. That's going to have some economic exposure. But generally speaking, a lot of these assets, we revalue them progressively through the year, both up and down as required. But generally speaking, when share markets are running hot, they don't tend to do quite as well as share markets do. But the flip side of that is when you go through periods of very bad volatility in share markets, they tend to hold their value to a greater extent.
So you really don't want all the pieces of the portfolio pie to correlate.
No, ideally you want a bunch of assets that actually more often than not uncorrelated or negatively correlated. So that if share markets do badly, you want something that's going to be doing well.
Yeah.
Bonds have traditionally done that. Not always, though, but bonds are part of that story. But the private assets are another part of the story. Any assets that we could include that by their very nature deliver a return but are capable of delivering a return that isn't dependent on what's happening in the stock market, that's a better story. It means that I can help smooth the ride for members along the way. The other story there is private equity. So in addition to investing in companies that
I
are
like when
listed,
you talk dirty to me, Brian.
oh my God, you nearly sounded like Donald Trump then, a bearded Donald Trump. It was
Don't
quite
get
eerie.
yippee.
Don't get yippee on me. Dan,
Don't get
yippee.
afraid.
Don't get afraid. I'm just going to post tariffs. I'm Mr. Tariff Man. But basically, private equity is investing in businesses, often small to medium businesses, that are not listed on the stock market.
Invest in mine.
But the other story there is private equity investments are going to be impacted.
Yeah.
So,
Why?
well, at the end of the day, they're companies. And if the stock market is telling you that a whole bunch of companies are now worth less than they were a few months ago, and if you've got a portfolio of private companies, well, you can't say, but my companies are fine, because maybe some of those companies are going to be impacted by the same growth outlook pressures or tariff pressures or whatever that the listed markets are.
And I think it's important to note, just from a real basic, I don't know the number off the top of my head, but private companies, unlisted companies, small businesses, right? I'll give an example. Like, I run a small business.
Yep.
There's 5 team members. And with all the uncertainty going on, as a small business, do I feel like taking some risks, using some of the cash I've got to invest for the future? Hell no. Do I feel like employing new staff members to grow the business? Hell no. Too much uncertainty. Businesses need regulatory certainty.
Correct. Exactly.
We need certainty in markets. We need certainty from the RBA. Actually, a question, I did a YouTube live the other night and someone asked me a question that I didn't know the answer to. And I'm going to ask you right after the break.
I might know the answer.
Yeah, well, that's right.
Well, let's give it a try anyway.
Let's give it a try. We'll be back right after this.